You ever have one of those nights where you're just sitting there, phone in hand, scrolling through headlines about inflation, interest rates, wars, elections, recessions, AI taking jobs, markets at all-time highs, and you just think, what am I even supposed to do with my money right now? Because maybe you've done the responsible stuff. You've got some savings. Maybe you've got index funds. Maybe you're contributing to retirement. But there's this little voice in the back of your head that says, yeah, but what if something breaks? What if the dollar weakens? What if the market tanks? What if everything feels stable until it isn't? And that's usually when gold and silver enter the conversation. You type it into YouTube, gold 2026 price prediction, silver breakout. Is gold still a hedge? And suddenly, you're in this rabbit hole of charts and dramatic thumbnails and guys pointing at $5,000 gold or $10 silver with arrows and fire emojis. And honestly, I get it. My name is Tim, and I spend way too much time thinking about money, human behavior, and why we all say we want security, but secretly chase excitement. I've gone down those same rabbit holes. I've looked at my portfolio and thought, maybe I should add more gold. Then 5 minutes later, actually silver might outperform. Then 5 minutes after that, wait, am I just reacting emotionally? Because here's the thing no one really says out loud. Gold and silver aren't just metals, they're emotional assets. They represent safety, fear, opportunity, protection, sometimes even rebellion. And in 2026, the question isn't just which one wins, it's deeper than that. It's what are you actually trying to protect? What are you trying to grow? And are you investing from clarity or anxiety? By the end of this conversation, you're going to see gold and silver differently, not as a hype trade, not as a doomsday bet, but as tools, very different tools for very different purposes. And once you understand that, the which one wins question almost answers itself. Let's talk about it. Let's start with gold. Gold is like that one calm, slightly boring friend who never panics. The friend who always pays their rent on time, never overreacts, never swings wildly from one extreme to another. Gold doesn't usually explode higher overnight. It doesn't promise you life-changing gains. What it offers is stability, reputation, thousands of years of human agreement that this shiny rock means something. And that matters. Think about this. Gold has survived empires, wars, currency collapses, political revolutions, entire civilizations rising and falling. Paper currencies? Not so much. In 2026, gold is still doing what it has always done, acting as a store of value when uncertainty rises. When central banks buy gold, it's not because they expect 10x returns. It's because they want insurance. When investors move money into gold during global tension, it's not excitement, it's protection. But here's where people misunderstand it. Gold is not a growth engine. If you buy gold expecting it to double quickly, you're probably going to feel disappointed. Gold moves, yes, it can trend strongly, but historically it doesn't compound like productive assets. It doesn't generate cash flow. It just sits there. And that's the point. Gold is the financial equivalent of a fire extinguisher. You don't buy it because it's thrilling. You buy it because if something catches fire, you'll be very glad it's there. Why this matters to you? If you're building long-term wealth and you already have investments that grow, stocks, businesses, real estate, gold can act as stabilizer. It reduces emotional volatility. It smooths the ride. It helps you sleep. Actionable takeaway? If your goal is protection, not explosive growth, gold makes more sense. But if you're hoping it will be the main engine of wealth, you might be asking it to do something it was never designed to do. Now let's talk about silver. Silver is not the calm friend. Silver is the cousin who shows up to family dinner with a new business idea every 6 months. Sometimes it works, sometimes it's chaos. Silver is volatile. And in 2026, that volatility is on full display. Why? Because silver is both a monetary metal and an industrial metal. That dual identity changes everything. Gold is mostly about wealth preservation.
Silver? Silver is tied to economic activity. Solar panels, electronics, EVs, medical equipment, technology. If the global economy accelerates, silver demand can spike. But if economic growth slows, silver feels it. So silver doesn't just respond to fear like gold does, it responds to growth expectations, to industrial demand, to supply constraints. That means silver often moves harder, faster, in both directions. In strong bull markets, silver can outperform gold dramatically. Historically, when precious metals run hot, silver tends to move later but more violently. That's exciting. It's also stressful. I remember watching silver during one of its big runs years ago, refreshing the price every hour. It felt like adrenaline investing. And I had to ask myself, is this strategy or is this just entertainment? Why this matters to you: if you're the type of investor who struggles emotionally with big swings, silver will test you. But if you understand volatility and can stomach it, silver can offer higher upside potential. Actionable takeaway? If you consider silver, do it with position sizing in mind. Smaller allocation, clear plan. Because silver doesn't gently fluctuate. It surges, it plunges, it does drama.
There's this metric called the gold to silver ratio. It simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio fluctuates. Sometimes silver is cheap relative to gold. Sometimes it's expensive. In 2026, investors are watching this ratio closely. When the ratio is high, it suggests silver may be undervalued compared to gold. When it compresses, silver is outperforming. But here's the important part. Ratios don't predict, they indicate. People sometimes treat this like a magic formula. Oh, the ratio is elevated. Silver is guaranteed to outperform. No, it suggests potential, not certainty. Markets don't owe us symmetry. Why this matters? If you're choosing between gold and silver purely on valuation metrics, understand that timing matters. Silver might be cheap and stay cheap for longer than you expect. Actionable takeaway? Use the ratio as context, not a trigger. If you're long-term focused, gradual accumulation beats trying to perfectly time relative value shifts. Now let's zoom out. In 2026, macro conditions matter more than ever. Gold and silver respond strongly to inflation expectations, real interest rates, the strength of the US dollar, and geopolitical instability. When real interest rates fall, gold often benefits. Why? Because gold doesn't yield anything. So when cash yields less in real terms, the opportunity cost of holding gold drops. Silver, again, reacts to both inflation and growth expectations. Here's the nuance. If inflation rises but economic growth remains strong, silver might outperform because industrial demand remains intact. If inflation rises while growth weakens, gold may shine brighter as a defensive asset. This is why the which wins question depends heavily on the economic backdrop. Why this matters? You can't choose intelligently without understanding the environment. Actionable takeaway? Ask yourself, are we in a growth cycle, a slowdown, a stagflation environment? Your answer helps guide allocation.
Let's be honest, most people buy gold and silver when they're scared. Not when everything feels calm, not when markets are smooth. They buy after headlines get dramatic, and that usually means buying after prices have already moved. I've done it. Maybe you have too. Fear compresses logic. It makes you want protection now, even if the best time to build that protection was months earlier. Why this matters? If you're buying metals as a reaction, pause. Actionable takeaway? Build your allocation during calm periods. Decide your percentage before the panic. That way you're not chasing spikes or selling dips emotionally. This is where clarity changes everything. Gold works best as a hedge. Silver can function as both hedge and speculation. If you allocate 5 to 10% of your portfolio to gold for stability, that's strategic. If you allocate 25% to silver hoping for a breakout, that's aggressive. Neither is wrong, but they are different. Why this matters? Mislabeling speculation as safety is dangerous. Actionable takeaway? Define your intention before you invest. Are you hedging or are you aiming for outperformance? Quick aside, because this matters. Owning physical gold or silver feels different than owning an ETF. There's something psychological about holding a coin. It feels real, tangible, reassuring. But it has costs, storage, liquidity spreads. ETFs are easier, liquid, simple. Mining stocks, that's a whole different layer. Now you're exposed to company risk, management decisions, geopolitical issues. Why this matters? Your vehicle changes your risk profile. Actionable takeaway? Match the tool to your goal. If it's emergency hedge, physical might make sense. If it's portfolio efficiency, ETFs might be better. Here's the answer no one loves. It depends. If 2026 is defined by geopolitical tension and falling real rates, gold may outperform. If economic growth surprises to the upside and industrial demand accelerates, silver could surge harder. Gold is steadier, silver is faster. Gold protects, silver amplifies. And maybe the smarter question isn't which metal wins. Maybe it's what role do you want metals to play in your financial life? Because wealth isn't about picking the flashiest asset. It's about building a structure that survives cycles.
So here we are. Gold versus silver. Stability versus volatility. Insurance versus acceleration. And honestly, you don't have to choose a side like it's a sports team. You're not trying to win an argument on the internet. You're trying to build a resilient financial life. Gold reminds us that safety matters, that history matters, that slow and steady has value. Silver reminds us that opportunity exists, that growth can surprise, that calculated risk has a place. The real victory in 2026 isn't picking the metal that spikes the most. It's building a portfolio that lets you stay calm when headlines scream, that lets you think clearly when markets swing, that aligns with your goals, not your fears. So before you buy either, ask yourself quietly, am I protecting something? Am I growing something? Or am I reacting to noise? Because once you answer that, the decision becomes simple. And simple, boring clarity, that usually wins. And there's something else that doesn't get talked about enough. Time horizon. Because gold and silver can both look like geniuses or disasters depending on the window you zoom in on. 6 months? Totally different story than 6 years. If you're checking prices every morning with your coffee, you're going to feel every twitch. But if you zoom out and think in decades, the emotional intensity drops. Metals aren't day trades for most people, they're long cycle assets. And when you stretch your timeline, you stop asking, what did it do this week, and start asking, what role does this play over 10, 20 years? There's also the psychological comfort factor, and I don't mean that lightly. Some people genuinely sleep better knowing they own gold. It's tangible, it's ancient, it feels like real money. Silver, on the other hand, can feel like a coiled spring, exciting, full of potential energy. One makes you feel secure, the other makes you feel opportunistic. Neither emotion is wrong, but you should know which one you're actually buying. Are you buying peace of mind or possibility? And here's a quiet truth. Most wealthy, disciplined investors don't bet everything on one narrative. They diversify across asset types, across risk profiles, across time. They might hold some gold for ballast, maybe a smaller slice of silver for torque, but they don't hinge their entire financial future on a single metal breakout. They build systems, and systems beat predictions, every time. So if you're sitting there in 2026 wondering which metal wins, maybe shift the frame just slightly. The winner isn't gold or silver. The winner is the investor who understands why they own what they own, the one who sizes positions rationally, the one who doesn't panic buy tops or rage sell bottoms, the one who builds deliberately instead of reacting dramatically. And honestly, that can be you. Not because you perfectly time metals, not because you predict macro cycles flawlessly, but because you decide, calmly and intentionally, what role these assets play in your life, and then you stick to it. That's not flashy, it's not viral, but over time, that kind of steady clarity compounds in ways that hype never will.